right, welcome back, everyone. We have a really special guest here today, Michelle Levin, who is a former Department of Justice tax attorney who's currently practicing in Huntsville, Alabama.
Thank you so much for having me, Natalie. I'm so happy to be here.
Thank you. Thanks for being here. I feel like I know you already from being friends on TikTok.
It's almost like a celeb sighting, like meeting your celebrity in real life when I meet people I've seen on TikTok. I love it.
Yeah. So let's jump into some questions. As you know, I practice family law, so we're going to kind of have the questions be centered around that. So when someone is filing for divorce or considering filing for divorce at a very high level, what are some tax considerations they should have in mind?
Yeah, thanks, Natalie. That's a great question. And I just wanted to, preface my answers in this discussion today with, even though I'm a lawyer, this isn't legal advice. Whoever's listening, I'm not your lawyer. And so you can't use this as legal advice. I also want to remind everyone that the tax code is constantly changing. It's one thing that Congress likes to fight over. And so what the tax law is today, it might not be tomorrow, or the tax law was in the past, it might not be in the future. So these concepts are, they are consistent. A lot of the concepts stay the same over time, but the specifics, the specific law, the specific exemption amounts, the specific requirements to claim something, those can change with time, and it evolves both as Congress changes the statute and as the IRS changes their guidance. And finally, sometimes the courts get involved and they have to interpret the tax law. And so that can change the requirements as well. So with that preface in mind, there's a lot of elements to income, to your tax, to what your taxable income is going to be that you need to think about when you're getting a divorce. First and foremost is how you're going to divide up the assets. There are certain transfers that you can make incident to divorce that are not taxable events. So if you are transferring your assets, and you should obviously consult with a tax advisor, but in transferring your assets, you have to make sure that you're doing it in the manner contemplated by the Internal Revenue Code and the regulations and IRS guidance to ensure that you're not creating a taxable event to yourself. And I've had folks come to me that were transferring an IRA account pursuant to a divorce, and they didn't follow the proper procedures. And so the IRS came in and said, well, when you pull that money out of the IRA to give it to your spouse pursuant to the divorce decree, that was actually a taxable event to you. And now you have to pay tax on the full amount of the money that you pulled out. So that's a very important consideration, is how are you dividing the assets? And when you're transferring them between spouses, are you doing it the correct way? Of course, the other really important thing to think about is, who's going to be responsible for caring for the children, who's going to be entitled to claim all the tax benefits associated with the children, including filing status, head of household, including child tax credits that you might want to claim. And again, those are fluctuating right now in Congress. The amount of the tax credit is always in flux. And then there's also child independent care expenses that you can claim tax benefits for if you've had those expenses. And so you're going to want to make sure that you understand those. And finally, child support and alimony, again, that changed in 2017, the way that alimony was treated for tax purposes. It used to be income to the recipient and deductible to the payor. It's no longer that way. So just look at the tax impacts of what you're going to be paying your spouse over time, child support and alimony. And is that going to be income to you as a recipient or not? And is it going to be deductible to you as a payor or not?
Yeah, that's really important to know. And I'm glad you prefaced before you provided the information with the fact that these things can change, and you let us know that this recently changed in 2017.
Yes. And it's always changing. Something else I always like to tell folks that's really important that I think a lot of people don't understand or are not necessarily aware of when they're filing their taxes is your tax obligation is between you and the IRS. And so the IRS determines what you owe, and you owe that. So if you have, even if you have an agreement as part of your divorce agreement, like I am agreeing that my ex is responsible for all tax liabilities, or I'm in agreement that my ex is going to take care of all the tax liabilities, that is not enforceable against the IRS. So the IRS can still come after you for any tax liabilities that are joint during your marriage. And that's what I see a lot of folks, that is really what a lot of folks struggle with after divorce, is that they might have in their divorce decree that one party's responsible for all outstanding liabilities, but the IRS is not bound by that. And so when someone comes to me and says, well, tell the IRS I don't have to pay it, my ex, agreed to it, here's our divorce decree. That was not an agreement with the IRS. The IRS can still come after you for any tax liability you owe. And then it's the burden's on you to go to your ex and try and enforce that divorce decree. And then they'll call you, Natalie. And then they'll say, I had to pay this money to the IRS, and under the divorce decree, I wasn't required to. And then Natalie's going to have to go into court and sue your ex to get that money.
Yeah, that's pretty much how that would work out. But yeah, that's a really important point to make, that your obligation to the IRS is to the IRS, and no one but the IRS can say whether you do or do not still owe that money.
Yeah. So I would, if you're getting a divorce, one thing that you could do is pull all of your IRS transcripts, make sure there's no outstanding liabilities, because some folks might not know that there's a liability on their account, and they don't look at their tax returns carefully, or their spouse has income that they are unaware of, but that the IRS is aware of. And so I would try and make sure that you have all of your past tax liabilities paid up before you separate ways, because if one party agrees to pay it, and as part of the divorce, there's not a guarantee that they actually will come through on that.
Yeah, that's a really good answer there. Can you give us a definition of taxable event? Doesn't have to be super technical, but can you describe what that means for people?
Sure. Taxable event, basically, Section 61 of the Internal Revenue Code said income is any money that you receive from any source. Okay, so the default rule under our Internal Revenue Code is that anytime you receive money, property, anything, that is considered income to you, adjusted gross income. And so when you're determining what your tax liability is, you start with income, and then you can look and see if something's excluded from income. So there might be money or a gift that you receive, or money that you receive, like a gift is a good example of money that you could receive, or an item that you could receive that is not considered income. So that's the typical example of something that you receive that's not income. But generally, the receipt of funds or the receipt of property is considered income. And then you identify the items that are not. You identify the items that have special tax treatment. For example, certain stock has special tax treatment, long-term capital gains. So if you sell an asset that you've held for more than a year, it has a special tax treatment. And then finally, you look at deductions. So what are expenses that you have paid that can reduce your taxable income? And that is and then you take out all the deductions, and then you pay tax on what's left. And so a taxable event is really, an event where you recognize income, where something is considered to be income to you.
Yeah, thank you for that. Let's jump over to a conversation about tax shelters and how they can help a person before and after divorce. I know people, when they hear tax shelter, may not really know what that means, but if we talk about 401ks or HSAs, people become more familiar.
Yes, tax shelter is, usually used, a lot of times it's used to describe an inappropriate structure that was created to generate a tax benefit, or really to shelter income from tax. So we just went over income. Basically, every event of receiving property or money is considered income. And so folks look to a way to shelter that income, so that income is not taxable. And there are some congressionally incentivized tax shelters, and you named really kind of the most famous ones, but there are really great opportunities to limit your tax liability, and that is to contribute funds to a 401k. You can contribute money to a IRA, and that's not taxable. That comes out of your paycheck pre-tax, the 401k contribution. So that's wage income that you receive that you're not actually going to have to pay tax on, because you're putting it aside in a retirement account. You can contribute to an IRA. There's an annual limit for that, and you get a deduction. So again, that comes off your income. You're not having to pay tax on that because you reduce your income by your contribution. And then health savings accounts, there's a tax benefit to that. Cause again, that's pre-tax, that's money that you earn, but you're not having to pay tax on because you put it in an account. And now, you have to be familiar with how to use those accounts to make sure that you are maximizing your return. I think there's a lot of my tax friends on TikTok, they always advise that you should always look at your overall economic situation. So sometimes you might be attempt to use a tax shelter or claim a tax deduction where it doesn't really benefit you economically. So you really got to look over the economic picture and don't let the tax tail wag the dog.
Yeah.
And if you watch TikToks, you're going to see everyone, oh, buy this, buy this G-Wagon, buy this, buy that. I saved all these taxes by buying these things. But a lot of times that means that literally that money is out of your pocket. And so when you claim a tax deduction, you're just saving, 30 to 40 cents on the dollar of what you would pay in taxes, but you're spending that whole dollar on whatever you're buying to claim the tax deduction. So you just need to look at the overall economic picture and make sure that that's a good, investment for you.
Yeah, it feels like they're kind of just showing you a part of the picture, and it looks really the part you see, but then you see the backside, and it may not actually be as economically advantageous as it looks from what they post in their 30-second video.
Right. Yes. A tax benefit may not benefit you overall economically. You have to look at your whole economic picture to see if it makes sense.
So you had another video. I've watched, I feel like every single one of your videos, but in one of your videos, you talked about the IRS and how they seem to target specific groups of people with respect to the earned income tax credit.
Yes.
Can you talk a little bit about that?
The IRS does not like the earned income tax credit. There's a lot of abuse of the earned income tax credit. Not to suggest that anyone listening to this podcast is abusing it, but I do know that there's a lot of abuse. That actually, for time, and when I was at the Department of Justice, there was a lot of folks, a lot of like criminal gangs that were actually filing false returns, claiming the earned income tax credit because it was a lot safer of an illegal activity to engage in. If you're engaging in drug dealing, whoever you're dealing the drugs with is a dangerous party, and they could shoot you, kill you. But so some of these gangs had started a side business of filing false tax returns, and that's just a lot less dangerous because all you do is send it to the IRS and you get a check back. And they would work with folks a lot of times in like nursing homes, in prisons, anywhere where you would have a list of individuals who are not regular tax filers, but you'd have all their names and all their social security numbers. And so they would have someone on the inside buy that information and then just fill out false tax returns. And if you fill it out in a certain way, you can maximize your earned income tax credit. So that's where the earned income tax credit abuse comes from. And so the IRS, obviously it's important to clamp down on fraudulent claims of earned income tax credit. But when the IRS's resources are limited, and their ability to hire, agents is limited by what they can pay them. And so earned income tax credit is fairly easy. And just a little bit of background, the earned income tax credit is a tax credit that was enacted by Congress to incentivize people to work. So if you are working and you have kids, like the more money you make, the more credit you receive. And again, I can't tell you the amounts because they change from year to year, but that's the long and short of it. And it's really kind of a mechanism that was created to generate bipartisan support, because you have Republicans who, don't want to do any entitlement or welfare spending for poor people. And then you have Democrats that do want to support them. So, which, I think we all agree is important to do. And so then you have them come together and say, well, we're going to give people money the more that they work. And so that's what the earned income tax credit is. It's to try and incentivize people to work. I really, as an aside, I really think the only people that are really incentivized by tax incentives are billionaires, because they're really the only people, or super rich corporations, because they're the only folks that can really afford to plan their affairs in order to maximize tax benefits. I think most people, are working because for the economics of it, they need to live, they need the money. They're not looking at, they're not looking at what their tax refund's going to be if they take a raise or not, because it's better for them to have that raise. And in any event, that's what the earned income tax credit is. But, from the IRS's perspective, those are cases that are easy to audit because you can put a lot of burden on the taxpayer to prove their income, to prove they're dependent. And usually taxpayers that qualify for the earned income tax credit are not going to be sophisticated. So they're not going to have counsel. They're not going to have the resources necessary to fully put on a full-throated defense of an audit the same way, a multi-million-dollar corporation would. So from the IRS perspective, it's more bang for their buck to audit earned income tax credit claims than it is to audit large businesses, because they have an advantage in those cases.
Yeah. And when the IRS does those audits, like, are they really going after high dollar amounts, or like, what is the benefit to the IRS to have that be a target group?
It's, on an individual basis, I think it's only a couple $1,000s, a few $1,000s. But I remember at one point in 2012, the estimate was that there's 9.2 billion in earned income tax credit fraud.
Wow.
So it's a big number on a large scale, but on an individual level, and I probably should look this up before I started, but I think it maxes out somewhere around $5,000 or $6,000.
But it sounds like it, as far as resources and the amount of investigation that it takes, it doesn't take as much manpower time.
Correct. It doesn't take nearly the amount of resources. And that's not to say, that some audits don't go very smoothly and people are able to work it out with the IRS. And it's, there are a lot of great folks at the IRS that just want to come to the right answer. They're not looking to, their job is not to maximize the amount of taxes that people pay. Their job is to make sure that people are paying the right amount of taxes. But again, a lot of the earned income tax credit folks are just unsophisticated. And so they might not have the best paperwork. They might not have the best substantiation. And I'll tell you an interesting story. We went to a tax trial. It was a virtual trial. And the taxpayer had claimed the earned income tax credit. And she was a single mom, and she worked at a restaurant. And so all of her income was paid in cash. The restaurant paid her in cash. And the restaurant went out of business, and they never issued her a W-2. And so her only evidence was that every day she would get home from work and she would write down how much cash she earned on her calendar, and then she deposited. Well, the IRS took the view that these were funds that her family had given her. They weren't actually money that she'd earned. And again, to claim the earned income tax credit, you actually have to earn it working. And so they disallowed it. And so she went to trial. She had a legal aid attorney representing her. Anyway, the trial was virtual. And so we were there. We were also assisting other taxpayers, not her. And she said, well, look, and the IRS attorney said, well, you didn't have anyone from the restaurant come testify to say that you worked there. How do we know that you worked there? And she said, well, look, I don't know who I'm supposed to get from that restaurant to come testify. The place is out of business several years ago. I don't know them. I don't have their phone number. She said, but if you, but they mentioned me on Facebook, guest patrons would come and they would say I did a good job serving them, and they mentioned me on Facebook. So during the court recess, the judge's clerk went on Facebook and found the comments from the diners, for all those years ago when she was. And so he brought that comment, and the judge said, can I take judicial notice of a Facebook post? In any event, the IRS agreed to concede that case, but that's just a flavor for how kind of these earned income tax credits might get challenged. Yeah. And if I had been representing her, the taxpayer in that case, I would have had someone from the restaurant. I would have gone, but sometimes you just don't have at the time the foresight to maintain the documents. The fact that she had maintained records as well as she did was incredible. Mm-hmm. But it's always about substantiation, and that can be challenging for less sophisticated taxpayers, but more sophisticated taxpayers will have all that paperwork.
Yeah, that's a really great story and great example of like everyone using the resources available to them to
Yeah.
know on
Yes.
Facebook when she mentioned that, and to take judicial notice of a restaurant having comments about her working there.
Yep. Have you ever had a Facebook post? I'm sure you have lots of Facebook posts in your cases. That's the first time I'd ever seen it in a tax case.
Yeah, I wouldn't have thought about a tax case having Facebook, but yeah, we have Facebook posts, text messages, emails, videos. I go to a lot of CLEs and we'll have stories that judges share about things that people bring to court. And it's just like, oh my gosh, really?
The internet is a vast source of information for litigation. That's without a doubt.
It is. And once it's posted, you can almost think that someone's done a screenshot or screen record or something, even if you don't
Yes.
see it later. All right. So I also wanted to ask you something that I get asked. Actually, let me go to another question. This question goes back to one of your videos. You have a video where you say, me knowing the IRS won't want to audit my return with 50 pass-through entities when the IRS can go after a single parent whose ex didn't report their income, their 1099 income.
You know what prompted that video, right?
Not sure, but let me know.
It was I think it was the Senate Finance Committee, a congressional committee released a report they'd received from the IRS on the audit of Donald Trump, because I think the IRS has a practice in place where they're supposed to audit all the president's returns. Mm-hmm. And so they were auditing Donald Trump's returns, but there was one revenue agent assigned, and he or she, I don't know if it was a man or woman, basically said that, they weren't able to really go in depth into Donald Trump's return because he had 400 pass-throughs on his return. So when you have one IRS agent and they're looking at a return that has income reported from 400 different pass-through entities, that means you have to go get all those returns before you can even really begin to figure out whether or not the income's reported properly. And just to take a step back, a pass-through is, there's certain kind of structures, corporate structures, partnerships being the main one, but also limited liability companies and S corps that they are not taxable. That's why they're called pass-throughs. So the income passes through that entity to the shareholders or to the partners. And so the individual members report out on their tax return. The entity itself doesn't pay any taxes. So that's why they call it a pass-through. And if a lot of your income is being earned by these entities and it passes through to your individual return, in order for the IRS to determine whether or not that income's correct, they actually have to audit the entity level return. And so if you have 400 different entities that you're getting the income from, that's 400 audits. And so that's a lot of work for the IRS. And I don't. That was obviously a joke, TikTok. Yes. I don't actually have 400. Yes. But when you have like W-2 or 1099 third-party income, I make a lot of TikToks about this, but where you received income from third parties, they have a reporting obligation. So your employer has a reporting obligation, someone that's paid you money as an independent contractor, or, they're going to have all this reporting requirements for Venmo or whatever. They have to issue you a 1099 and they have to file with their IRS. And so that's when the IRS goes into matching. They're always trying to match everything. Mm-hmm. And so if they have something with your social security number or, your husband or wife's social security number on it, it's supposed to be associated with your return is not reported. That's an easy case for them because they have a third party showing that you received that income. You didn't report it on your return. It's an easy case for them. But if you're going to have to look through 400 different returns to determine whether or not income's reported properly, that's a tough case.
Yeah. So I love your sense of humor and I love the legal humor behind that post. And education is that letting us know about pass-through entities and how that impacts the tax structure.
Oh, well, I'm happy to do it. I think, the tax code is very complicated and it benefits those who can make their taxes complicated. It can
Mhm.
also set you up for a lot of trouble. So I don't want to say, we should always make our taxes as complicated as possible. We could also set you up for doing it incorrectly because you have a lot more requirements to comply with, but it definitely does make things harder from the IRS's perspective in an audit.
Yeah. So something that comes up a lot for my clients is Form 8332, which allows a parent to allow the other parent, if they are not the custodial parent, to claim the kids on the taxes. I know that you said that you're familiar with this form, but if you could talk a little bit about that and the tax implications for the child tax credit.
Right. So, having a child has a lot of tax benefits associated with it. And I saw a really funny TikTok about it, where a guy was said like, all my friends got their child tax credit money yet. Why is the government paying everyone so much money for their kids? And I think it's not really so much that they're trying to incentivize people to have kids as much as the Congress is trying to incentivize people to take care of their kids, right? Because in order to claim the child tax credit, you actually have to not only be the parent of the child, but you have to have them reside with you for 6 months of the year, and you have to provide more than 50% of their support.
Mhm.
So you can claim the child tax credit not just by having the child, but by supporting the child. That's what we're trying to incentivize. And as I mentioned earlier, there's also child independent care expenses. You can also claim them as a dependent, and it could in fact affect and the child tax credit is a credit that you receive. It's actually cash from the government versus claiming someone as a dependent. That's going to reduce your overall taxable income, the number of dependents that you have. So they're slightly different. And then also your filing status can impact, what your tax rate is, how your income is taxed. If you're a head of household filing status, you have a higher thresholds to hit before you're at the different tax brackets. So sometimes, and so going back to the beginning when I said, when you make an agreement with your ex, that's not an agreement between you and the IRS. And so if you have an agreement with your ex about who's going to claim the child, unless you have an agreement with the IRS, y'all could both try and claim the same child, and then both of you are fighting it in audit, and that's going to cost more money.
Mhm.
So the form that you mentioned, the 8332, allows you to kind of notify the IRS about who's claiming the child. And that way, if there is a question during an audit, you've already submitted that form, the IRS is on notice. So now you kind of brought the IRS into your agreement, and it avoids a lot of headache and consternation on the back end. And I think people make a decision, probably better than I do, about who's claiming children. Is just part of the economics of the dissolution of the marriage. And so that is just one more way to provide one party with more money or, some sort of financial benefit without actually having to pay that out of pocket.
Mhm. Yeah. So we've loved having you as our guest here. Are there any parting words you'd like to share about anything tax related or not?
Well, if anyone ever has any issues with the IRS, first of all, don't be scared, but also don't ignore it. There's a lot of deadlines involved in disputing tax liabilities, collection activities. So if you get a letter from the IRS, definitely open it, look for deadlines, reach out to a tax advisor if you have a question about it. And there's also a service known as the Taxpayer Advocate Service. It is a service within the IRS that's dedicated to helping taxpayers. And so if you have an issue with the IRS, you can always reach out to the Taxpayer Advocate Service. They have, you just Google it. I don't have they have local offices in every state. You can call, you can get a case officer assigned, and they can help you navigate any challenges that you have. But, 9 times out of 10, The IRS is just trying to get you to pay the correct amount of taxes. And but don't ignore it. And if you have any questions, I'm sure there's lots of bad advice on TikTok. I guess that should be my final parting words. Do not take tax advice from TikTok.
Yeah.
Including me.
Videos that myself included, they're all informational, they're general. Half the time we're just kind of joking around.
Yeah. Yes, it's all joking around, but I really appreciate you having me on. This is really fun. And, this is my jam. So anytime you have any tax questions, let me know. I won't necessarily have the answers, but I'll know how to get them.
And how can people find you on TikTok?
Oh, my handle is tiktok.taxlawyer, for as long as TikTok is unbanned.
Yeah.
If we get banned, I don't know. I'm not going to Instagram Reels. So you'll just have to hunt me down. I guess I'll just have to go back to working full time.
Find another hobby.
Yeah, find another hobby.
All right, Michelle. Well, thank you so much for being our guest today. I hope that everyone finds the information very helpful. I know I did. And we'll talk to you guys again soon.
All right. Thank you so much, Natalie. Love being here.
Thank you so much. Bye-bye.
Thanks. Bye.